As Dina mentioned earlier, the market in Q3 remained volatile as we expected. Assets that are sensitive to interest rates have repriced on the back of high rates for longer scenario. At Innova, we believe the rally to July was driven by an overarching theme of generative AI. However, declining market fundamentals and impacts from rate hikes had to be considered. The rally seemed to be based on four legs of a chair: strong and robust GDP, falling inflation, strong employment, and expectation for multiple rate cuts in 2024. Dina explained why we felt this fourth assumption wouldn't hold true if the other three were to realize. And we know the devil's always in the detail. We tend to think that the economy is more fragile than what simply the headline data is suggesting. GDP and employment numbers are lagging indicators. Focusing on more forward-looking indicators paints a slightly different picture. Yield curves remain inverted, signaling a softer condition ahead. Manufacturing PMIs and gross domestic income remains weak. Services inflation remains sticky with a fragile housing market. Recently, further risk emerged from geopolitical tension in the Middle East, and we continue to see supply-side risks in the US Treasury market posing risk of high rates. However, if a scenario of strong economic growth was to eventuate, with the labor market remaining strong, inflation receipts, and the Fed cut rates, then we expect the market rally to broaden into other areas. So far, the Magnificent Seven and the Nasdaq have already priced in this Goldilocks scenario, so they are likely to lead the next leg up. While as other parts of the market remains potentially attractive where positive news is not fully priced in. Areas like cyclical sectors, value equities, cyclical regional markets, and high-grade credit should participate more fully in the rebound. On the other side, in the scenario of a larger economic slowdown, we also argue that since starting valuation matters, markets whose valuation remains much more modest offer a larger margin of safety in this scenario. Although they are likely to make money in a bear market, we do predict a lower downside. We also expect long-dated government bonds to also provide protection in this scenario, as central banks now be forced to reassess their policy direction since economic slowdowns are in nature deflationary. To put it all together, we believe the current market pricing structure is offering asymmetrical opportunities in certain parts of the market. What it means is that investors need to be more active and selective in their portfolio allocation, stay diversified, and buy into areas that are different to the majority of the market, and look harder for opportunities and assess their risk-return profiles, not just in one, but in multiple possible scenarios.